3 days into the new year, Bitcoin broke something. Right now on South Korean exchanges, something is happening that hasn't fully happened since 2018. The price gap has widened past $8,000. And before you assume that's normal, understand this. It shouldn't exist at all. Now let me take you inside what just happened. And I mean just happened. In the last 72 hours, the data is fresh. The implications are still crystallizing. And what you're about to understand will reframe how you see not just cryptocurrency, but the entire concept of global capital flows and the illusion of truly borderless markets, Bitcoin in South Korea. Let's talk about what this means. On December 31st, Bitcoin was trading around $88,000 across major global exchanges. Coinbase, Kraken, Gemini, the standard price, the price that defines the asset globally. But then you look at Korean exchanges, Upbit, Bithumb, Coinown. The numbers tell a different story. One Bitcoin on a Korean exchange is trading at approximately 129 million Korean won. Let me convert that for you. That is $127,000 USD equivalent for the same asset, the exact same Bitcoin. The difference is not rounding error. It's not volatility lag. It's approximately $8,000 per coin. Think about that specific number. $8,000, not 500, not 2,000, 8,000. And yes, this is happening in real time. This is not historical. This is not 2018 nostalgia. CoinMarketCap and Being Crypto both confirm this premium as of early January 2026. The data is live. The spread is real. And the question is, how is this possible in 2026? The answer reveals everything about how the global financial system actually works versus how we're told it works. South Korea has capital controls, strict ones, the kind they don't advertise in tourism videos. Individual residents can legally purchase foreign currency up to an annual cap, approximately 50,000 USD, before triggering regulatory scrutiny. That's it. 50,000 per year, per person. If you want to move more, you need documented justification, business transfers, educational expenses, family support. Without the documentation, the one doesn't leave. It stays trapped. It stays domestic. Now imagine you're an arbitrage trader. You understand markets. You see inefficiencies. You could theoretically buy Bitcoin at 88,000 on Kraken, then transfer it to a Korean exchange and sell at 96,000. That's an $8,000 profit per coin. It's absurd. It's impossible. And yet, it should be trivial. But here's what stops you. Capital controls. If you're Korean, moving $96,000 out of the system sets off alarms. The Korean Financial Services Commission is watching. The Customs Service is watching. Banks are watching. Recent crackdowns have uncovered $9.84 billion in illegal Forex transactions, with 73% directly linked to cryptocurrency arbitrage. That's not theoretical punishment. That's real enforcement. And if you're not Korean, trying to move one into the Korean system in the first place requires a local bank account, wire transfers with documentation, and patience. The friction is intentional. The friction is designed. The premium exists because the arbitrage is too expensive to execute at scale. This is called the Kimchi Premium, named after the fermented cabbage dish. It's been around since Bitcoin's earliest days. In January 2018, it hit $8,000. Bitcoin was $45,000 on global exchanges. In Korea, it was $53,000. That was the first time we saw this dynamic exposed to mainstream awareness, and people thought it was crazy then. Now it's back, and the mechanics are identical. The desperation is identical. The supply-demand imbalance is identical, but the context has changed. Everything else around it has evolved. And that evolution tells you something profound about what's really happening in global cryptocurrency adoption. Let me rewind to November 2024. The Kimchi Premium was nearly zero. It had collapsed. All year in 2025, it had hovered around 1%. Sometimes positive, sometimes negative. The premium wasn't just small, it was almost non-existent. Analysts attribute it to regulatory tightening, reduced liquidity, and the fact that South Korea had stopped being an anomaly. The market had normalized. Korean prices were aligning with global benchmarks. The closed ecosystem was opening up. But then, something shifted. In December, speculation began. Retail investors in Korea started feeling something, momentum, a sense that Bitcoin was about to move. Institutional money had been quietly flowing into Bitcoin ETFs throughout October and November. US spot Bitcoin ETFs had opened floodgates. Billions of dollars were flowing in. The fear and greed index was climbing out of extreme fear territory. Technical indicators were turning bullish. Korean retail investors saw it. They felt it. And they did what they always do in this situation. They moved aggressively. The one started flowing into Korean exchanges. Domestic capital trapped by regulation suddenly found its highest conviction use. Buy Bitcoin as much as possible. Push prices higher locally. And a gap opened. first at 3%, then 5%, then toward $8,000. This is the Kimchi Premium in its truest form. This is not hedge fund arbitrage. This is retail desperation meeting regulatory friction. Here's what makes this moment unique, though. Here's what matters now, in early 2026. South Korea's Financial Services Commission just announced new regulations. They're proposing ownership caps on cryptocurrency exchanges, 15 to 20% maximum. This would force founders to divest significant stakes. This would convert privately held exchanges into quasi-public infrastructure. Lee Jae-myung, the newly elected president, is pushing a pro-crypto agenda politically because nearly 6 million Koreans hold cryptocurrency. Both political parties see it as electoral leverage, but enforcement is coming anyway. The Digital Asset Basic Act will finalize in early 2026. It mandates 100% reserve-backed stablecoins. It requires third-party custody. It imposes new compliance burdens on exchanges. The message is clear. Korea wants to professionalize its cryptocurrency market. But that process is messy. Regulatory uncertainty breeds speculation. Speculation breeds premiums. The $8,000 gap right now is a symptom of that uncertainty. It's a symptom of retail traders making educated guesses about how this plays out. If new regulations lock down exchanges, the premium could expand further. If regulations ease, arbitrage becomes possible, and the premium compresses towards zero. Investors in Korea are betting that the premium persists, that they can lock in gains before capital controls get stricter, that the regulatory environment, despite all the reform language, will still preserve some element of the closed system that makes the premium valuable. This is where psychology enters, and it's darker than simple greed. Loss aversion is driving behavior. The Crypto Fear and Greed Index spiked out of extreme fear territory just recently. Korean retail investors had been burned badly in 2022 and 2023. Exchanges collapsed. Accounts were frozen. Money was lost. But Bitcoin has recovered above 88,000. The pain of the losses is still fresh, but the gains are visible now. Sitting on the sidelines and watching Bitcoin rise feels like slow torture. So when the premium started forming in December, when the local price started climbing higher than the global price, Korean retail traders interpreted it as a signal. The signal that they could get ahead of the next move, the signal that their market was special again, that their local demand was creating an edge. Herd behavior amplified the effect. As the premium widened, more traders noticed it, interpreted it as validation of their thesis, and pushed capital in. This is the herding dynamic documented in psychological studies on cryptocurrency investors. Social media amplifies the effect. Twitter and Korean discourse is all momentum calls, all FOMO language, all talk about how Korean exchanges are leading the market recovery. That talk becomes self-fulfilling. Here's what's actually happening in the aggregate, though. Here's the mechanism beneath the psychology. South Korea's cryptocurrency market is now the second largest trading jurisdiction for Bitcoin, denominated in fiat currency. The Korean won accounts for nearly 4% of all Bitcoin trading pairs globally. That's significant. That's meaningful. But it's less dominant than it was in 2018, when Korea punched above its weight. Global institutional money is distributed differently now. Bitcoin ETFs have democratized access across geographies. U.S. investors don't need Korean exchanges anymore. European institutional funds have their own pathways. Asian money is spreading across Singapore, Tokyo, Hong Kong. Korea is no longer the only bridge to cryptocurrency for ambitious investors. But Korea is still uniquely insulated. Capital controls mean Korean money is captured. It can't easily go elsewhere. That creates a sealed demand curve. More one chasing Bitcoin domestically. Limited ways for Bitcoin to flow out of Korea to global markets without friction. That sealed curve creates the premium. And the premium, paradoxically, is a weakness, not a strength. It signals that capital is trapped. It signals that the market is inefficient. It signals that arbitrage opportunities exist, but can't be captured without regulatory risk. In efficient markets, such premiums don't persist. They're arbitraged away instantly. The fact that an $8,000 gap exists for days is itself evidence of market dysfunction. It's evidence that South Korea's financial system is operating according to different rules. Those different rules served traders well in January 2018 when the premium was $8,000 and Bitcoin was only $45,000. Buying at 45 and selling at 53 in a different currency zone felt like discovery, like an unfair advantage. But in 2026, when Bitcoin is already 88,000 and adding another 8,000 feels like a rounding error in percent terms, the premium is a warning sign, not an opportunity. It's saying the fundamentals don't justify the price divergence. It's saying retail is overextended. It's saying local demand is unsustainably aggressive. Here's what the premium is actually predicting: volatility and reversal. Historically, when the Kimchi Premium spikes beyond its mean, Korean market corrections follow. CryptoQuant and on-chain analysis firms have documented this repeatedly. The premium is a retail FOMO indicator. It measures pure retail desperation. When it spikes, it means retail is buying at the worst time, driving local prices ahead of fundamentals. Research from trading firms indicates that premium zero crossings, where the premium shifts from positive to negative, predict Bitcoin reversals with 67 to 70% accuracy over 7 to 30-day windows. It's a contrarian signal. When the premium is extreme, the market is stretched. We're stretched right now. But before that reversal, something else happens. Regulatory enforcement. The FSC has been monitoring Korean exchange compliance since December 2024. Bithumb reported compliance delays. Upbit reported that recent FSC guidance has tightened surveillance over capital flows. Binance Korea shut down entirely in 2021, not because of cryptocurrency price volatility, but because of regulatory pressure on fiat on-ramps. If the FSC tightens capital controls enforcement to reduce the arbitrage pressure, here's what happens. The $8,000 premium doesn't persist. The local price has to normalize. That means a crash on Korean exchanges. That means local traders holding Bitcoin at 96,000 suddenly see it drop toward 88 or lower. That means losses. But if the FSC remains lenient and the premium persists, here's what happens instead. International arbitrageurs eventually find ways to exploit it. They bring in wire transfers, create local bank accounts, hire local traders, use stablecoins. They slowly start buying Bitcoin at 88,000 globally and shipping it to Korea to sell at 96,000. The premium gradually compresses as supply increases on Korean exchanges. Either way, the premium dies. It's not a persistent phenomenon. It's a window, a temporary dislocation, and the window is closing. Korean retail traders buying at 96,000 with leverage, with borrowed money, with their life savings because they feel FOMO and loss aversion, are buying at precisely the moment when regulators are closing the door and arbitrageurs are waking up to the opportunity. This is not a conspiracy theory. This is market structure. This is how information asymmetries work. Retail moves first on emotion. Institutions move second on incentives. Regulators move third with enforcement. The timeline matters here. The premium has been zero or near zero all of 2025. It only spiked in December when retail sentiment shifted. That spike happened before institutional money had time to react. Institutional traders at major crypto hedge funds, at family offices, at proprietary trading firms, they would have noticed this dislocation in November or early December. By now, in early January 2026, they're positioning. They're creating entities to capture the spread. They're building wire transfer infrastructure. They're studying the regulatory landscape. They're calculating the risk-adjusted return of exploiting the premium. And that positioning, once it starts, once the capital flows across borders and onto Korean exchanges, once the supply of Bitcoin increases on Upbit and Bithumb, once the local price starts compressing toward the global price, that's when the real pain hits the retail traders. The pain of buying at the top of a local market, the pain of watching the premium collapse, the pain of leverage liquidations, the pain of regret. It's a cycle that repeats. 2018, 2021, 2025, 2026. The same psychology, the same mechanics, the same outcome. Here's the deeper issue, though, the one that goes beyond Korean retail traders and their futures positions. This premium is a symbol of a larger fragmentation in global cryptocurrency markets. Despite Bitcoin's theoretical borderlessness, despite blockchain's promise of decentralization, price discovery is still fractured across geographies. Capital controls still matter. Regulatory regimes still matter. The promised global, liquid, efficient market for digital assets has not materialized. Bitcoin is not truly liquid globally if an $8,000 spread can persist for days. It's locally liquid, regionally liquid. But globally liquid? No, this has implications far beyond Bitcoin's price. It suggests that cryptocurrency has not yet achieved the kind of market integration that would make it a true alternative to traditional currency systems. It suggests that borders are not meaningless, that regulatory friction is real, that arbitrage opportunities can persist for extended periods. That's actually bullish for central bank concerns about cryptocurrency. It proves that digital assets are not an immediate threat to monetary sovereignty. They're constrained by the same capital controls that have always existed. They're subject to the same regulatory enforcement. They can be fragmented by geography, just like traditional currency. But it's bearish for the cryptocurrency ideology itself. It reveals that true decentralization requires not just technology, but also policy change. You can't have a borderless currency if borders still matter. You can't have a frictionless monetary system if friction still costs money. The $8,000 premium is Bitcoin admitting something uncomfortable. It's still a local phenomenon. It's still embedded in geography. It's still vulnerable to policy. Now, let's talk about what happens next. And let's be careful here, because prediction is harder than pattern recognition. The Korean regulatory environment will tighten. We know that with high confidence. The Digital Asset Basic Act will finalize. New requirements for custody reserves and compliance will take effect. Those requirements will reduce speculative volume on Korean exchanges in the short term. If volume drops, the premium likely compresses towards zero. That's the most probable outcome. Regulatory enforcement reduces local demand, local prices normalize. But there's a secondary scenario. What if the regulations, despite being strict, actually legitimize the market? What if major Korean financial institutions, KB Financial, Shinhan Bank, enter the cryptocurrency space through stablecoin pilots and custody services? What if the Digital Asset Basic Act, despite its restrictions, actually makes Korean exchanges more professional and more accessible to institutional money? In that scenario, Korean cryptocurrency volume could expand on the institutional side, even as retail volume contracts on the regulatory side. The premium might collapse, but for a different reason. Because legitimate institutional arbitrage actually makes the market efficient. That outcome would be structurally more stable. It would mean the premium is replaced by tight, deep, institutional-grade liquidity. It would mean Korean markets are no longer a retail-driven anomaly, but a proper institutional hub. Looking at the regulatory roadmap, that's what the FSC is aiming for. The ownership cap proposals are designed to convert exchanges from retail casinos into quasi-public infrastructure. The reserve requirements for stablecoins are designed to attract institutional trust. The ISMS certification and cold storage mandates are designed to professionalize custody. This is not regulation designed to kill cryptocurrency in Korea. It's regulation designed to transform it. For retail traders holding positions at $96,000 waiting for further gains, that transformation is bad news. The premium dies. Their edge evaporates. They're left holding Bitcoin at local prices that have to reconcile with global reality. But for the long-term vision of Korea as a fintech hub, as a major player in global cryptocurrency infrastructure, that transformation is necessary. The $8,000 premium, in other words, is a friction point that had to be eliminated. And it's being eliminated right now. The question for traders is one of timing. When does the premium collapse? Is it next week? Next month? Is it already compressing? The answer depends on how aggressively the FSC enforces, how quickly international arbitrageurs mobilize, and how soon Korean retail realizes that the FOMO signal is actually a reversal signal. My assessment, based on historical precedent, is that the compression happens fast once it starts. In 2018, the $8,000 premium took approximately 3 weeks to collapse once arbitrage began. The process was visible for those watching. Exchanges reported increasing inflows of Bitcoin. Local prices started gapping down. Leverage positions got liquidated. The smart money that moved early made money. Everyone else learned expensive lessons. The timeline this time will probably be similar. You're looking at a 3 to 6 week window before the premium is mostly gone. That window started in early December when the premium spiked above 5%, so the clock is ticking. Here's what we can say with confidence. The $127,000 Bitcoin price in Korea is real. The $8,000 premium is real. The capital controls that created it are real. The regulatory enforcement coming is real. What we can't say with certainty is whether this premium persists or collapses. The outcome depends on human behavior, regulatory decisions, and global capital flows. All of those are uncertain. But the uncertainty itself is valuable information. It's telling you that Korean cryptocurrency markets are not stable, not efficient, and not safe for retail traders who don't understand the mechanisms creating the premium. If you're Korean and you're holding Bitcoin at $96,000, thinking you found an edge, think again. You didn't find an edge. You found a symptom of market dysfunction. And symptoms, by definition, are temporary. The Kimchi Premium is back, but it's not a long-term feature. It's a short-term dislocation, a window that's closing, a signal of retail FOMO that historically predicts reversals. The $8,000 gap exists because of capital controls, regulatory uncertainty, and retail desperation. And when regulatory clarity arrives, and it will, that gap disappears, and the traders who benefited from it don't get to keep their gains. They get to explain their losses. This is the actual story of cryptocurrency in 2026. Not a revolution in global finance, not a bypass of banks, not borderless money winning. This is the story of digital assets being confronted by the reality of borders, capital controls, and government enforcement, and adapting to fit into that reality, and slowly, brick by brick, becoming just another financial system embedded in geography and policy. Bitcoin broke through $88,000 globally in early January 2026. That's the real story. That's the global narrative. It's driven by institutional adoption, ETF inflows, and a genuine shift in how serious money thinks about digital assets. The $127,000 premium in Korea is the footnote to that story. It's the illustration of how that global story plays out differently in different jurisdictions. It's evidence that the promise of borderless, censorship-resistant money still requires borders to create the inefficiencies that make it valuable. Understand both stories. The global price is the trend. The Korean premium is the warning. And that warning says, when an asset diverges wildly from its global price in a specific geography, It's not an opportunity. It's a setup. It's a pattern waiting for a reversal. It's retail buying at the peak of local sentiment right before institutional pressure normalizes the price. Learn to recognize those patterns. Learn to recognize when FOMO is real and when it's a symptom. Learn to recognize when a market is stretching past its fundamentals, because the Kimchi Premium always collapses, and the traders on the wrong side of that collapse never see it coming.